As we mentioned, just crossing the wires, the consumer products giant earning $1.06 a share for the quarter. That was 3 cents better than the street was expecting. Revenue also beating forecast. And joining us right now to break down the numbers is Procter and Gamble's CFO and Vice Chairman Jon Moeller. Jon is also a member of the CNBC Global CFO Council. And Jon, it's great to see you this morning. Thank you for joining us.
Happy to be here.
So it looks like the numbers were better than expected on just about every metric. Looking through organic growth, that's probably one of the most important measures. You saw organic growth up 5% in the quarter. What really drove that?
Well, this is the third quarter in a row of very strong volume sales, consumption, and market share growth, being driven by our strategy of superiority of product, package, communication, value, go-to-market across the 10 categories where we've chosen to compete. Fueled by productivity to fund investment in superiority as well as to build margin. Core earnings per share in the quarter on a constant currency basis up 15%. We're also focused on cash flow productivity. Free cash flow productivity 100% on the quarter. We increased our dividend. We're going to pay a dividend for the 129th consecutive year. This will be the 63rd consecutive increase. So things are moving pretty well behind this superiority strategy fueled by productivity and strengthen organization design and culture.
Yeah, you know, Jon, the stock has gotten kudos from the street for that organic growth that you have been delivering for several quarters at this point. And the reason is it's not just coming from price increases, it's coming from product innovation, too. Can you kind of walk us through and tell us where you've done innovation? What have been some of the more successful launches that you've done that's really driven things?
Well, the real measure of success for innovation, as we look at it, is can we move markets? Can we inflect the rate of market growth? And with that, disproportionately grow our business and our share and do it in a profitable and sustainable way. And a good example of that we've talked about for some time but still has tremendous legs is unit dose laundry detergent. Tide Pods, Gain Flings, Ariel Pods in Europe took a market detergent that was declining about 3 to 4% per year, and it's now growing about 4% a year. That item is 2x the price per wash load, and it's driving both retailer margins and profitability as well as ourselves, and importantly, growing the whole category so that all boats rise. Another good example in that same general category is our laundry scent beads, which have taken the fabric enhancer category, and which is now growing at high singles, and our business, which is growing in double digits. Again, same story, consumer relevant innovation in categories where performance drives brand choice.
You know, it's interesting that you bring up those Tide Pods, because I do feel like you've been talking about that for years. I mean, years at this point about that being an innovation. Tell me about something new that's happening, like oral care. I saw that the organic growth there was very strong, and part of that is because of premium organic care, oral care in developing markets, I think I read. What's happening with that? Well,
oral care is growing very well, as you said, behind both innovations on the Paste platform, but also, very importantly, strong innovation on the premium Power Brush platform, including Power Brush 9000, which uses the internet and other digital tools to aid the user brushing experience. In every category we're in, we're focused on bringing breakthrough, meaningful, relevant innovation that grows the market and grows our business with it. Feminine care is another good example. We grew feminine care the last quarter 7%. And the primary driver of that growth is Always Infinity, which is a premium, highly absorbent product in feminine protection, and our adult incontinence business, which has taken that market and doubled its growth rate since it was launched several years ago.
You know, while we're talking, I'm looking at this, and like I said, every number that I've looked, every metric that I've looked at looks like it's better than had been anticipated. However, the stock is off by about 1%. That's a decline of just over $1. What do you think the street is seeing in here that maybe it didn't like?
Again, it's a very strong quarter. We've got a long day ahead of us, and we'll see where we end up at the end of the day.
And I will point out the stock has been up and has outperformed its peers for over the last 12 months, too.
Correct.
Jon, I just want to ask about the sort of macro outlook and where you feel the consumer surprised you to the upside or the downside across the globe in this quarter.
Generally, the upside across the globe. So if we look at market growth rates in dollar terms as a symbol of consumer confidence and consumer health, It's generally ticking up. We've seen that in the U.S. We've seen that on a global aggregate basis. China, which everybody's been concerned about, continues to grow extremely well. We just had an 11% growth quarter in China. I mentioned the U.S. We had a 4% growth quarter in the U.S. So in our categories, we generally see very good health and strong consumption.
You know, John, one of the things you told us last quarter is that in terms of China, you had not seen any downturn in the markets there. And that was in juxtaposition to what we saw from some of the major companies like an Apple. And I'm trying to think of who else. There were a couple of major U.S. companies that did see a downturn in China. What have you seen to date?
Continued strength. That's a market that's growing high singles to double digits, depending on the category. Baby care, for example, is growing strong double digits. Skincare is growing strong double digits. I'm talking about the market and our business with it. So generally, continued strong consumption.
Hey, John, you know, there's been a number of big direct-to-consumer players who we've talked about over the years that have competed with you, some of which you've acquired. How do you see that dynamic, this sort of I don't even know if we call them startups anymore, but playing in your space?
Well, first, we want to serve consumers however and wherever they want to shop. If that's direct with us, that's great. If that's through an online aggregator like Amazon, that's great. If that's at their local Walmart or Target or CVS or Walgreens store, that's great. And we need to be relevant in each of those instances as relates to the shopping experience and product availability for our consumers. Direct-to-consumer itself is still a relatively small segment of the overall market. I would estimate less than 2%. That doesn't mean it's not relevant. It's very quickly growing, and it's something we're increasingly competing in, as you said, making small acquisitions to build our capability, as well as developing that capability internally.
How much of your brand, I mean, long-term, how many of your brands do you think are going to have a truly direct-to-consumer franchise? And obviously, I'm thinking of the Dollar Shave Clubs and the Harry's and all of that in that space. But in terms of your own brands having that same type of relationship?
I think the majority of our brands will have one-on-one consumer relationships, both from a communication standpoint and a purchase standpoint. But, you know, again, I think the more prevalent growth engine is going to be the online aggregators. There aren't that many families that want to purchase 100% of their household care needs by going to single product manufacturers direct, going to 20 different websites with 20 different passwords and 20 different delivery dates and 20 different packages. It will be relevant, more relevant in some categories, and will be fully present there. It will always be relevant to a certain subset of consumers. But again, we need to be broadly relevant across all shopping experiences.
And John, in a similar vein, since you mentioned Amazon, there seems to be so much commotion around Amazon politically and elsewhere. I'm curious what you think of the idea of these white label products that effectively compete with you. White labeling has gone on forever. Costco does it, Walmart does it, everybody does it.
Yes.
But there seems to be increasing concern, at least in Washington, that some of these white label products are ultimately competing with people on the quote-unquote platform. How do you think about that?
Well, as you've said, own label competition has been a part of our industry for as long as I've been involved in our industry, which is over 30 years. We intentionally focused our portfolio 2 years ago. We went from 17 categories down to 10, 175 brands down to 65, to focus on categories where performance drove brand choice and where usage was on a daily basis. And in those categories, we feel very comfortable competing against own label products. We need to deliver a superior experience for the consumer who is choosing a brand based on performance. That's somewhat different than some of the adjacent categories to us, but we feel very good about our standing as long as we do our job and deliver a truly superior experience.
Hey, John, really quickly, we've got to run, but we did just hear from Twitter. Where is Procter and Gamble putting the bulk of its advertising right now, and are you looking at any new channels?
We're constantly looking at new channels. We're pretty well distributed across both traditional and digital spending. It depends on the market and the category. China, for example, a huge portion of our business is now online, and a disproportionate amount of our advertising is digital or social in nature.
Here in the United States, are you going back to traditional more, though?
I wouldn't say we're going back. We're taking very careful looks at what each platform offers us, not only in terms of perceived return, but in terms of brand integrity and safety, and ensuring that we're putting our money to its best use.